back to this week's market update. Today is Monday, May 12th, 2025, and we will jump right in. Stocks were muted last week as investors looked for clarity on potential trade agreements between the US and its key trading partners, particularly China. As of Friday, May 9th, the Dow Jones Industrial Average slipped just about 0.16%, the Nasdaq Composite down just shy of 0.3%, and then the S&P 500 down about 0.5% last week. Bonds also edged slightly lower with the Barclays Aggregate Bond Index down 0.2% last week. Moving into our economic news from last week, the Federal Reserve held its May meeting and, as expected, made no changes to the federal funds rate, maintaining the target range at 4.25 to 4.5% at the meeting. And this continues the pause in policy rate moves since the last rate cut in December of 2024. Federal Reserve Chair Jerome Powell was fairly balanced, highlighting the strength in labor markets and resilient consumer spending, despite the weaker first quarter GDP number, which was dragged down by a surge in imports. He also acknowledged the rising risks tied to new tariff policies, including the potential for upward pressure on inflation. The meeting had no major surprises, but market expectations have trended to become less dovish in recent weeks. Markets are no longer expecting a rate cut in June. Instead, futures now imply about a 57% chance of a cut in the late July meeting. And with this being a fairly mixed probability for a rate cut in July, that may move even into September if markets become a little bit less dovish. We also got the ISM Manufacturing and Services Indexes for the month of April. We had the manufacturing index come in at 48.7% in the month, a slight decline from March. And this was largely driven by lower production here. You can see falling quite a bit from March, as well as things like new export orders falling quite a bit, largely tied to the tariffs, and the backlog of orders also contracting. So several factors at play here, but continuing to see a decline in the manufacturing industry. On the other hand, economic activity in the services sector continued to show resilience in April, with the ISM Services Index rising slightly to 51.6 in the month of April here. This was largely driven by three components: business activity, new orders, and supplier deliveries that were positive in the month. Employment was negative, but it did improve quite a bit from March to April. So overall, services not as bullish as we have seen in previous months when the index was up to, 53, 54, 55, but it does continue to be a sign of growth in this side of the economy. Also last week, the Conference Board's Employment Trends Index, or ETI, declined in April, marking its lowest level since October, signaling increased uncertainty about the strength of future job growth. Private sector labor market data held relatively steady throughout April, but some forward-looking indicators of the index showed early signs of strain, including the share of consumers that reported jobs are hard to get. That rose for the third consecutive month, the highest level since October as well. And the percentage of small businesses reporting unfilled jobs fell to a level not seen since September. So a relatively weaker month of employment, although we are not in a full-blown recession by any means yet. Broader consumer economic expectations declined to their lowest point since October of 2011. So that is one of the indicators that is quite bearish. We've seen that in consumer confidence. We've seen that in other household surveys of how consumers are feeling. They are at quite a low point for many of them, the lowest since the post-financial crisis era. Last but not least, taking a quick look at our recession signals, since many of them have been updated in the last week or two. We have currently 3 bullish indicators, 4 bearish indicators, and 1 neutral. So definitely tilting a little bit bearish, but overall still pretty mixed in these indicators. Looking ahead, we expect the anxious index to become more bearish this week. It is a survey of professional forecasters' probabilities of real GDP declining in the next quarter. And with the first quarter of economic growth showing a decline, we expect that they will increase the odds of a recession in the coming quarters just due to currently having a negative quarter of growth. So overall, still a pretty mixed bag. Definitely leaning a little bit bearish though. Thank you so much for tuning in to this week's market update, and we look forward to providing another update to you very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.